Good afternoon, everyone. Welcome to today's AFSA Business Partner webinar, Beyond the Paperwork, Stopping Asset Finance Fraud with Identity Intelligence and Intelligent Decisioning. We are pleased to have you with us today. My name is Grace McGurn, and I'm the Communications Manager for AFSA. Today's webinar is sponsored by NetSol. They are a highly engaged AFSA Premier Business Partner, and we greatly appreciate their support. Your presenters for today are Eva Kellershof, Vice President Sales, North America and Europe at NetSol Technologies, and Tommy Madsen, Principal Solutions Consultant at Socure. A couple of housekeeping items. Your mics and cameras have been disabled to ensure there are no disruptions. The webinar is being recorded and will be available on our website next week. If you have any questions, please post them in the chat, and we hope you enjoy the webinar. Now I turn it over to Eva and Tommy.
Thank you very much, Grace, and thank you for the kind introductions and also presenting the title slide. Well, let me just jump in right there. We are living through an era of profound transformation in asset finance and retail operations. As transaction speeds accelerate and applications move entirely online, the vulnerabilities in our traditional systems have become impossible to ignore. So today, I'm thrilled to co-host this session with Tommy Madsen, Principal Solutions Consultant at Socure. Together, we are going to unpack a major shift in the fraud landscape, one where standard document and bureau-based defenses are no longer enough to protect your business. Over the next 45 to 60 minutes, we will look at the real data driving this surge, show you how to look past perfect paperwork to see who is actually behind an application, and demonstrate how identity signals can be orchestrated into real-time decisioning. So now let's start by introducing ourselves. Well, I'm AVP of Sales for North America and Europe at NetSol, as Grace mentioned, and over my 20 years in fintech and automotive, I've worked closely with lenders, OEMs, and captives on strategies, processes, and systems. What we are seeing today is that fraud is no longer just a risk management concern. It has become a core operational bottleneck that slows down legitimate customers. I'm joined by Tommy Madsen, as I said. So Tommy, over to you.
Cool, thank you very much. My name is Tommy Madsen, and as the states, right, I'm a Principal Solutions Consultant at Socure, primarily focusing on identity verification and fraud prevention through a wide swath of our customers, ranging from third-party fraud to synthetic fraud to first-party fraud. Really excited to be able to talk to you all about today about some of the changes we're seeing in the industry and what we can do to prevent it.
Perfect. So in this webinar, we're going to combine Socure's world-class identity intelligence with NetSol's end-to-end decisioning and lifecycle orchestrator, our Transcend platform, to show you how and what modern unified defense looks like in practice. So thanks again for joining me today, Tommy. Now, let's set the stage with the section 1. So to understand where we are going, we have to be entirely honest about where we are today or where we are right now. In 2026, the asset finance leaders are facing a paradox. Our originations processes are more automated and digitally streamlined than ever, yet our fraud losses are rising at an unprecedented rate. We call this the fraud problem hiding in plain sight. It is hiding because the files we are approving look flawless. The paperwork is completely filled out, the credit scores are high, and the documents check out, yet the losses are still hitting our portfolios. So let's look at the hard numbers that define this challenge. So these are the baseline realities of the market today. First, the scale of the exposure is staggering. According to Point Predictive's latest data, US auto lending fraud exposure reached a record $10.4 billion in 2025. That is up from $9.2 billion year over year and nearly 5 times what the industry faced in 2010. But the composition of this fraud is what should really worry us. 69% of that exposure is first-party fraud. This isn't just professional, external hacking rings. It is real people using their identities and slightly manipulating profiles to commit dishonest acts. In fact, income and employment misrepresentation alone makes up 45% of that exposure, rising 21% year over year. What makes this worse is the downstream economic multiplier. The LexisNexis True Cost of Fraud study shows that for every single dollar of direct fraud loss, the actual cost to the lender is over $5, That's a 25% increase since 2021. When a vehicle or asset walks off your lot, you aren't just losing the asset value, you are paying for legal fees, recovery attempts, operational overhead, and compliance audits. Now, let's talk about the silent killers, synthetic fraud and generative AI. Synthetic fraud, where a fraudster creates a brand new identity using a mix of real and fake data, is projected to cause $23 billion in annual financial losses by 2030. 85% of these synthetic profiles slip completely past traditional third-party models. Why? Because they are paired with a 644% rise in dark web discussions focused on generative AI and deepfake fraud tools. Fraudsters are using automated AI agents to build, nurture, and season fake credit profiles over months. By the time they apply for an asset loan, their credit scores are pristine, their papers are perfect, and they walk away with high-value vehicles before you even realize the identity was completely fabricated. Gen AI fraud losses alone are on track to jump from $12.3 billion to $40 billion in 2027. So how is this happening? Well, the core issue is that many lenders treat these statistics as separate, isolated challenges. They are not. They are symptoms of a singular structural category shift. Our traditional document and credit bureau verification workflows were built for a fraud landscape that simply did not exist anymore. In the past, if a document was signed, a utility bill was uploaded, and a credit score was pulled, the risk analyst cleared the deal. Of course. Today, those checks still pass. The documents look perfectly formatted because they are generated by AI. The credit bureau data reconciles because the synthetic identity has been carefully nurtured for months, carrying a credit score above 650 or showing a perfect history of small payment payoffs. The analyst has absolutely no reason to hesitate, and that is exactly the problem. This is why synthetic identity is the ultimate silent killer. They look like your absolute best customers right up until they cash out and vanish. Even internationally, we are seeing this evolution. In Europe, while total identity fraud volumes dipped slightly in 2025, the sophistication of the attacks rose dramatically. Fraudsters are launching fewer, highly targeted, highly intelligent attacks that mask their underlying risk. If your underwriting team is relying on physical document review and simple credit bureau matching, you are blind to this shift, and you are evaluating the paperwork, not the person behind it. So before we talk about how to solve this, I want to hear from you, our audience. So this is our first call I want to shift to. So the question is, we'd like to open our first poll to the audience. Where do you see the biggest fraud exposure in your origination workflow today? 1, synthetic identities passing document review. 2, dealer-assisted or first-party application fraud. 3, impersonation or stolen identity. 4, forged or manipulated supporting documents. Or 5, honestly, we don't have visibility into where it's coming from. And you see the window in front of you. Please cast your votes now on your screens. All right, this is building up. Anything surprising you, Tommy?
I'm not seeing the answers, actually. Let me see here.
Oh, I think you also have to submit a response, and then you'll see the answer as well. Yeah. So we're seeing for the first part, or for the first question, or the first assessment, the majority of it, right? Or I'd say at least, there's a top 3, and then there's the bottom. So number 1, number 2, and number 3. I think it's good that at least the audience is informed about where the fraud is coming from, so we can neglect about probably the fifth part. But I think it's really interesting coming from here to the section that you're now presenting, Tommy. So if you want to take it up.
Yeah, definitely. And I will say I am surprised to see that first party is actually not leading this from what I'm seeing out in the field right now. It is very prevalent, especially in the auto space. Yeah, so why don't we jump ahead to the next slide, kind of give you an introduction to Socure, kind of give you an idea of why I'm able to come through and speak to this. So for those of you that aren't aware, Socure is an identity verification and fraud prevention company. We've been around since 2012, and ever since then, we've actually been going through and building machine learning models solely focused on combating different types of fraud, right? So that can range from first-party fraud to synthetic fraud to third-party fraud. And really what we do is work with our customers, many of which you see here, to mitigate that at account opening, at account change, throughout any part of the consumer life cycle. As you can see, right, we work with a wide swath of different companies. They range from banks to fintechs to gaming companies, sports books. We have relationships with many public institutions, whether those are federal, state, or local. And really what that allows us to do is see fraud as it's perpetrated throughout the network. So it could be a fraudster operates differently at a Bank of America as opposed to potentially, right, a Dave.com. We're able to see those different channels and actually build models that can help mitigate those as the fraud attempts jumped. One of the other great things is that we actually have a first-party fraud consortium where we get contributions from many of the logos that you see here, where they tell us if they've seen a customer or consumer at that institution commit first-party fraud through either an ACH chargeback, a dispute, a fraudulent dispute, or a credit chargeback, which actually allows us to be able to go through and see behaviors for first-party fraud and help mitigate that as well. If we jump ahead to the next slide, this will kind of go into how we're able to go through and do that, right? As we said, we have about 3,000 customers, maybe a little more than that. All that information we see from them helps feed into our global graph. And you can kind of look at the way Socure operates and the way our products work as two halves of a whole. We have our global graph, which is built of all of our network data, our features, our data that we purchase from other different data vendors out there, right, that we actually utilize to go through and build and train and really reiterate on our models, because fraud changes all the time, especially in the age of AI, right? So we go through and we target that and we release new models yearly. We also have this local graph that sits within our platform that actually allows our customers to see how consumers are interacting with them on different touch points, and being able to pair these two graphs together, we're actually able to help them go through and mitigate these frauds. Again, so it's the global graph, which is everything that Socure sees, where you get clear insights, right, from fraud attempts that are happening or even that have happened at different members of the consortium, compared to the local graph we're seeing, where maybe we're seeing someone from an auto space go through a pre-qual and then a few months later go into a dealership, right, and maybe go and actually get a full issue, and we can see, okay, is the information the same that we had in that pre-qual that might have expired? As we move forward, right, really, I think the main thing that we want to talk about here is the different types of fraud and how we're able to go through and work with that. And I know we went through and did the poll and we touched on many of these types, and we can roll through these a little briefly. But I think in the auto space, there's two here that are really the most prevalent in terms of impact right to the bottom line here. So third-party fraud, right, that is, as we all know, it's probably the most common that we see. This is truly stolen identities. This is third-party fraud. This is maybe Ava using my information to go and take a line out. It is probably the lowest hanging fruit in terms of utilizing maybe some bureau data to go through and fight this, because the information is not necessarily going to match, right? As we see what's on a file there. Maybe we'll see a different date of birth, right? Maybe we'll see a different phone or an email that hasn't been seen with that identity before, but really it's something that might be able to be caught with a document check, right? If we step up to a driver's license or something like that, or something else that's on file. Now, as we look at first party and synthetic fraud, these are much harder. And this is where we're seeing, right, the bureau data and the document checks really fall short. First party fraud, right? This is Tommy using Tommy's information to go and commit this. Maybe I don't care about my credit, maybe I don't care about my reputation, and I'm going to go ahead and go through and personally commit fraud with my information without a care in the world. I'm always going to pass documents, right? Because it's me. I'm always going to pass a bureau check, right? Because, hey, that's my credit. I've been paying it, and I'm going to match that. Similarly, right, synthetic is fairly similar. As Ava had stated, right, these synthetic identities, right, create credit profiles. They propagate through the bureaus. Of course, they're going to match because they exist. Maybe they'll go and they'll create their accounts at a different institution to start slowly building up that credit profile to go above a 650, above a 700, until they get to such a point that they can go through and bust out. They're going to look clean. And in this day of generative AI, right, it's really easy for a fraudster to go through and create fraudulent documents, whether those are driver's licenses with the synthetic information on it, but the true fraudster's face that will then match if they go into a dealership and show, right, that document, similar to, bank statements, other address records, right, very easy to go through and create with generative AI. So when we utilize that identity graph that we talked about in the previous slide, we can actually go through and build models that don't just look at the PII that we can see, but actually look at the behaviors, right? Look at, do these match for synthetic identities? Do we see proof of life? If the date of birth for this identity indicates, they're in their late 30s, we should see some educational records. We should see some tax history. We should see some history on our graph that goes past, the last 3 years. So we can go through and take all that into account to go through and help build, right, our synthetic models, which will go through and mitigate these synthetic frauds. Same for first party. Maybe we'll utilize, some of that identity data and see if maybe I'm just using a different phone number, right? Trying to bypass that so that you can't call me to collect. Well, we can go through and see that within our consortium and actually utilize that to say, okay, we have different numbers for Tommy, and what he's doing is manipulating his own identity. So that's a way we can go through and really help stop some of these first-party frauds before they get booked. If we jump ahead to the next slide, I think we have some interesting stats we can roll through here. So for first-party fraud, I mentioned before, we have this consortium that we built. As part of building that, we actually went through and did some polls, similar to the ones we're doing here on this webinar, but these were more broad, right? Opened up to the whole internet within the US. And what we actually saw was shocking. About 34% of Americans actually admitted to engaging in first-party fraud at least once. Now, if you can imagine, if 34% of them admitted to it, probably more have done it, but have not admitted to it. And first-party fraud can be anything of, hey, you know what, I wanted to buy something online. I didn't have the funds, but I put it on my credit card, and then I said I never got it delivered, right? It could range from, hey, I deposited money into this ATM, I never got it. Hey, I didn't send that check. All these things that we can go through and see, right? Again, go through and build these behaviors. And one of the things we also saw was that, not only did 34% of Americans admit to engaging in it, about a third of those also admitted to doing it more than once. So it's a repeat behavior, especially if someone gets away with it. It might be a way for them to say, hey, you know what? I got away with this. Maybe I'll do it again. And if it's such a low amount, maybe I won't get in trouble. As we look at what's causing people to do this, again, yes, there obviously is the case where, many people who have done disputes, have cited financial hardships. Hey, I needed to get something to eat. I didn't have funds, but I went through and I purchased it and said, hey, I didn't do this. But again, a vast majority are admitting to doing it because they got away with it. So we want to make sure that we can go through and stop these from happening for you. As we move forward here, I think it's important to look and see, okay, like, what are the commonalities between people who have done it once and done it again versus accounts that we see? And this is some of the information that you'll be able to utilize, right, as we look at this. About 70% of first-party fraud offenders have opened multiple accounts within a short time span. So that could be account jumping, that could be going through, but it's a signal to someone who will potentially commit first-party fraud based on historical actions of others, right? Again, they're about 7 times more risky than good users, people who have gone through and created, opened multiple accounts within a short time span. And only 11% of good users, as have been reported to us by our consortium. Again, there's about 30 institutions that provide us, accounts, and not just their bads, but their goods and their bads, and if they went bad, how they went bad, why they went bad. We're able to go through and use that and actually, dig into the data. We are a data science company at our core. We're able to dig into that data to go through and find these commonalities, find these signals that can help stop these first-party fraudsters and synthetic fraudsters from happening to you. One of the things that jumps out as well, right, is over 80% of the first-party frauds that are seen are caught within the first 6 months of the company. So it's something that if you will see a first-party fraud event, you will see it within those first few months of payments, whether they'll maybe do a never pay or they'll pay once and stop paying, but you will, be able to highlight these and track these within those first few months. All right, on the flip side, as we go to the next slide, we can look at, synthetic identities. And while, first parties, it's a lot of times, right, the accounts are great until they go first party, right? Because it is just truly me having my bank account, having my loan, having my credit card. But for synthetic identities, that's where we see something different, right? It matter if they go good or they go bad, they are always truly a synthetic identity. And what we have seen is about 3% of all accounts, all banking accounts in the US are synthetic identities. Some of these could be sleepers, right? Some of these could be mules. Some of these could be, again, just slowly building up credit history to go and make a big purchase and bust out. 20% of all credit card and loan charge-offs are a result of synthetic fraud, as we've seen. And as Ava had mentioned earlier, by 2030, we see synthetic fraud losses potentially being into the $23 billion range. Obviously, that is a huge amount of money that truly you cannot go after anybody. It is synthetic identity. You could look to find the individuals behind those synthetics, right? But a lot of times they're using, email addresses that are recently created. They're using phone numbers that maybe are VoIP numbers or are burners that you can't really tie back to an individual. So it really is, something that we have to go through and mitigate ahead of time. You want to stop these synthetics before they come on the books. And I think it is,
just a quick one. Yeah, so you're saying like 3% of the accounts are actually held by synthetic identities. And you were saying like one of them are either sleepers or mules. So mules are having multiple of them, or what's the definition of those two?
So yeah, a sleeper account, right, could just be a bank account that's dormant, right? A mule account could be used to just transfer funds, maybe for nefarious purposes, right? For people who can't own banks. Foreign nationals who can't have a bank account within the US, they want to be able to transfer those funds out. It could be a synthetic identity that is just sitting there and being used to facilitate those fund transfers.
Mm-hmm.
But again, that's just for DDA accounts. As we look at credit cards, as we look at loans, there's obviously more that could happen there. And I think, yeah, as I was saying, right, it'd be remiss to not state the obvious, which is with generative AI and the future of AI as we go and propagate, it's just going to be easier and easier and easier for bad actors to create synthetic identities. Whether that's, I've seen really, really good fake documents. It's also really easy to go and create a curated identity. Right. And it's not just, me going through and creating it. It's me writing a script to go and create a bunch of curated synthetic identities and then maybe go open those up in, smaller credit limit institutions to go through and build a credit line or add as, authorized users, whatever I might want to do. It's just really easy for bad actors to go through and create these fraudulent identities. We can move ahead. What I wanted to show here was really just a case study that we had done, specifically targeting first-party and synthetic frauds. So this is a customer of ours that had a separate solution in place already for first parties and synthetics. They were not using our models. They were using our third-party models and other models of ours at account opening. But what we wanted to do was showcase, hey, we could help you solve this other problem that you're seeing. So as we went through and did this test, we did a test on about, a year's worth of data. So that's going to, take into account seasonality. Maybe there's certain months where we have higher sales. Maybe it's a little more dormant in certain times, spread, across the whole 12 months. So it wasn't, picked from certain areas. It was just all volume. And what we saw was that, utilizing minimal friction on these booked accounts or issued loans, we can identify over $8 million of fraud losses on top of everything else we were already catching. So that's right off the bat of straight rollers, of never pays, of delinquencies, that these lines would never be issued. For their current solution that was in place, this was a huge lift. So currently they were only catching about 4 basis points, or sorry, 40 basis points of these straight rollers. We were able to catch over 13% of those. So a huge increase in terms of those frauds that could be captured by just utilizing products that just worked alongside the ones that we already had deployed for them. And I think what's also really unique that we were able to go through and do, as I mentioned, this first party fraud consortium, where we're told, we're suspecting these individuals of committing these fraud. They've done these chargebacks. They've done these disputes. We saw accounts within those 12-year period that hadn't gone bad yet, but represented another $3.5 million in losses as reported to us by other consortium members. So it's important, as I said before, right? First party frauds generally show up within the first 6 months, could be after. Synthetic identities can show up way after that. But being able to know, hey, there's losses that we are uncovering or we can predict will happen is relatively, not even relatively, it's very important, right? As we can go through and look to stop these before they hit your bottom line.
Yeah, totally. I mean, maybe just another, it's not even an anecdote. I mean, it's one structural finding I think that we went through at Netzel. I mean, obviously this is more like an asset finance webinar, but at Netzel, we're also providing dealers and OEMs with digital retailing solutions and omni-channel platforms. And obviously, this is where a lot of the consumers are coming in online, right? And then basically also submitting their car application to get their next car online. And what we find here, because we partner with Socure and have been for the last 5 years, that we do a thorough KYC check, that looks into all those databases and whatnot. And we're able to prevent, those credit frauds right at the very beginning. Whereas when consumers just walk into a dealership and then walk onto the lot, and then what usually happens is that dealers just verify their identities through credit bureaus, which is always falling short, because we no longer live in that landscape anymore. And so I think that's where the powerful conversation is coming in about, how useful is digital retailing. It's not only to capture deals or leads or anything like that, but really to prevent you from making losses with customers who you don't know.
Definitely. And I mean, you can imagine, right? Obviously, you can collect more information online generally than you are going to be in a dealership, right? If someone is, on their computer, on their phone, filling out a web application, you can pull the device, you can get the device information. You can prompt them for an email and phone, they're going to go ahead and give it to you. You can collect everything. When someone's at a dealership, though, especially if, we're looking to run credit, maybe we're not going to go through and collect the phone or the email. Obviously, there's no device information to get. In some cases, the lender might require, right, a phone or an email, and a dealership might just put in a placeholder, right? 555-555-5555, or email@email.com, right? Something that just fills in the system that is not actually going to tie back to the individual. It might actually give a false positive or false negative, where we're going to say, hey, that phone or that email is not tied back, but it's actually just because it's invalid. So there's definitely, certain, I would say, things to look at when we're comparing, dealership applications that are on-prem versus digital, and there's strategies that we can work with and can be done to target each segment, right, appropriately. It's just, definitely as things move more digital, and I think it's worth it to push for more digital because there's just more information to get. There's a lot more signal that's available.
Perfect. All right. So then let's move to our next poll, I would say. How confident are you that your current process would catch a well-constructed synthetic identity? So number 1, very confident. We have strong identity verification in place. 2, somewhat confident. We'd catch most, but not all. 3rd, honestly, not very confident. And 4th, we're actively reevaluating our approach right now. So please, again, cast your votes. I think that's exactly where, the human factor comes into play. Times are just moving so fast. We all really don't know what we know and what we don't know. And so honestly, we're not very confident about what we're getting. So I think that's probably very common among your consumers or your clients as well, Tommy.
Yeah, I mean, especially in this day and age, right? Things are rapidly changing. Yeah, there's always the chance to increase capture, right? That is always true.
Yeah. Cool. All right. Oops. Now let's move on to the next section. Thank you, Tommy, so much for this part. Now let's address the second half of the equation. So having world-class identity intelligence is essential, but if that signal sits in a standalone silo, it is just noise. It won't stop a deal from funding in real time. So to protect your portfolio, that identity signal must land inside an intelligent decisioning engine, one that can orchestrate rules, credit models, compliance policies, and fraud risks simultaneously. That is where Netzel and our Transcend platform come in. So let's look how we turn these signals into real-world business actions. Now, for those who are not familiar with Netzel, we are the global standard in asset finance technology. For over 4 decades now, we have powered the systems behind many of the world's largest automotive OEMs, equipment captives, and financial institutions. With operations spanning North America, Europe, the UK, and the Asia-Pacific region, we have successfully executed over 350 implementations for more than 200 global clients. Whether it's managing omnichannel retail operations or orchestrating complex finance and leasing frameworks for household automotive names or global machinery, Netzel systems are the backbone of seamless customer journeys, high volume origination, funding, and portfolio management. Because we manage the core operational workflow where the application actually lives, we are uniquely positioned to weave intelligence into every single stage of the asset lifecycle. So let's look at how our platform structures this. So this is the Transcend platform. It is our unified end-to-end digital retailing and asset lifecycle engine. It manages everything from the moment a customer's asset and payment selection through credit application, credit decisioning, e-contracting, funding, collections, and finally remarketing to a second life cycle, right, for the consumer and asset take place. So what makes our Transcend unique is how we have woven our intelligence layer, which we call trade cycle management intelligence, directly into every stage of this life cycle. TCMI, as we call it, uses predictive analytics and agentic workflows to drive customer retention, maximize in-life revenue, and optimize remarketing decisions. So our approach to fraud is simple: integrate best-in-class and compose the decision. So rather than building a rigid closed ecosystem, Transcend is built on an open API-first architecture, and Socure's identity intelligence plugs therefore directly into the core of our decisioning workflow. Traditional credit bureaus, alternative KYC checks, and specialized data providers sit alongside it, all orchestrated by your specific business policies. You get a single, cohesive decision rather than a series of fragmented, disconnected manual steps. Obviously, all that within having AI with the human in the loop. And so let's look exactly at how we orchestrate these signals. With Transcend, we orchestrate all incoming data into one unified credit decisioning engine. Rules, risk models, compliance policies, and manual review requirements are managed in a single place. By default, every decision is fully explainable and audit ready, which is absolutely vital for regulatory compliance in 2026. So instead of having separate disjointed workflows for your fraud, credit, and compliance teams, a policy change in Transcend is applied everywhere simultaneously. When an application is submitted, our system pulls and evaluates 5 key signal categories in real time. First, identity intelligence. We run Socure signals to instantly flag whether we are dealing with a real verifiable human being or a fabricated synthetic identity. Second, obviously, the traditional route continues to exist, bureau and credit data. We pull traditional and alternative credit history, active trade lines, and existing debt loads. Third, income and employment. We verify pay stub integrity, third-party employment databases to confirm the applicant has the financial capacity they claim. And obviously, we ingest AI into this in order to do this on a very sophisticated level. Fourth, fraud policy and rules. We run your custom business-defined rules with a complete audit trail. And fifth, behavioral signal and device signal. We analyze session data, device profiles, and behavior patterns at the exact moment of application. So this orchestration happens in milliseconds, giving you a comprehensive multidimensional view of risk before a deal is ever sent to underwriting or funding. To appreciate the power of this automated orchestration, think about your underwriting team today. So imagine a busy analyst who is looking at deal number 47 of the day. They are tired, they are under pressure to hit funding targets, and they are rushing to clear the queue. It is physically impossible for a human reviewer to manually cross-reference dozens of disparate data points on every file without letting things slip. So Transcend acts as an automated shield that supports your analyst in 4 key ways. First, it catches incomplete documentation automatically. If a document is missing, low quality, or partially filled, the application is flagged before it ever wastes an analyst's time in the underwriting queue. Second, it surfaces data inconsistencies instantly. If there is a mismatch between the submitted paperwork and real-time third-party data, Transcend highlights it immediately. Third, it delivers consistency at scale. The exact same high standards are applied to every single application, regardless of the originations channel, the dealer group, or the specific analyst reviewing the file. And fourth, it drives faster decisions. By embedding identity intelligence directly into the core decisioning flow, we eliminate manual back and forth, drastically reducing the volume of fraud that slips through traditional views. So in this, let's launch our third poll. What's the single biggest barrier to strengthening your fraud defense in the next 12 months? A, integration complexity with the core platform, internal alignment between risk, fraud, and originations teams, budget and ROI justification, lack of visibility into where current losses are coming from, or fifth, concern about adding friction for legitimate applicants. Cast your votes, please. Let's just wait a couple more seconds. Yeah, what can I say? Selfishly, I like the response. Integration complexity with the core platform. Obviously, we like to help with that as we are helping with software issues and digitization in this era. So we understand you, we hear you, and I think that's what we often get into conversation, or what we often get in conversations where we're talking about, old monolithic platforms that are unable to master the integrations that are needed to, power a consistent ecosystem of fraud prevention, third-party providers, et cetera, et cetera. So very cool. Thank you for that. And so let me now take this up again and ask about what this means for each team that we face. So when you bring identity intelligence and automated decisioning together, you create a coordinated single view that benefits every single corner of your organization. So this is not just a tool for the risk team. This is not a silo tool whatsoever. It is something of a higher comprehensive and integrated view. So how do these these 6 key audiences actually work across your business? First, obviously, risk and fraud teams. They can finally catch synthetic, first-party, and impersonation fraud that document reviews miss, so drastically reducing costly post-funding loss events. Second, obviously, that their credit models are scoring real applications rather than fabricated identities that will inflate the book and turn into write-offs. Third, originations and dealers. Because legitimate applicants are verified instantly in the background, they clear the workflow faster. So suspicious deals patterns are flagged early, leading to better, cleaner dealer conversations. Fourth, compliance. With Transcend, compliance gets explainable AI and fully auditable logs. Policies are applied consistently across every single transaction, eliminating analyst to analyst variation. Fifth, portfolio and remarketing. By leveraging NetSol's core platform and TCMI layer, you retain better residual value, accelerate vehicle turnarounds on returned assets, and execute stronger recovery strategies. And sixth, and finally, which is equally as important, executive leadership. So executives get a highly clear, compelling ROI story on both sides of the ledger. You avoid direct losses on the front door while retaining maximum asset value across the lifetime of the book. Now, as we're getting closer to the end of this webinar, this is what happens when you really stop managing fraud in isolated silos and start managing it as a unified and company-wide strategy. Let's now look at the key takeaways that you can take home from today's webinar if you've followed us until here. So the number one key takeaway, I think, is that it's out there. I think everybody has understood it. The paperwork test is officially over. Fraud that beats today's document and bureau checks is not a technology gap. It is a massive category shift. Lenders who continue to rely solely on checking PDFs, utility bills, and bureau credit files are fighting yesterday's war. You must now shift to verifying documents and from verifying documents to verifying identities. Number two, signal without decisioning is just noise. Identity intelligence is highly necessary, but it is not sufficient on its own. It has to land inside an automated credit decisioning engine that can turn that signal into consistent, compliant, and auditable action in real time. And finally, three, better fraud defense equals a better customer experience. Many lenders worry that stronger fraud checks will introduce friction for their good customers. The reality is the opposite. The exact same signals that detect a synthetic identity are used to fast-track real, legitimate applicants. This isn't a trade-off, it's a massive friction reduction that helps you get close clean deals and that faster. So now, Tommy, let's look at the road ahead in terms of what's next in the real. Yeah. So why now? Why do we have to do it now? One, I think 2026 is here. AI is here. You've heard from Tommy. It's a massive shift in terms of synthetic fraud. And that's something that, you cannot just reflect on the population that's out there, but, it's a massive, let's say, multiplier in terms of how many synthetic identities can actually be created. So the real cost is really what slips through. For every $1 of visible fraud loss, we carry $5 plus in total cost downstream. I think that's what we established at the very beginning. Secondly, AI is really closing the window. So synthetic identities, we've touched upon it many times, are just here and they're not disappearing. And basically, technology is setting the pace and we have to catch it through technology again. And then this is an add, not a rebuild. So we think that identity intelligence really drops into the decisioning workflow that you already run. You don't have to exchange any systems. It's just a necessary and a highly recommended add-on to what you need to run in your back office. Now, looking at the road ahead, I think we can distinguish between three different timelines. So one in the short term, so less than a year. As we said, AI is already deeply embedded in applications. So fraudsters are using machine learning to generate these fake pay stubs, bypass deep fake ID checks, and scrub red credit files. So Gartner explicitly predicted in February 2024 that standalone identity verification checks would become completely unreliable from many enterprises due to these injection attacks, forcing a shift toward device and behavioral signals. At the same time, dark web chatter on AI fraud tools is up 644%. So to fight back, majors like JP Morgan and MasterCard are already deploying live agent AI to learn and counter new fraud patterns in real time. Now, in the mid to long term, so 1 to 5 years or 1 to 3 years, we're going to see a complete structural shift in how applications are submitted. For instance, we talked about the 40 billion AI-enabled fraud already, and that fraud tooling goes mass market. But in the 3 to 5 years category, we see, for instance, in the EU, that there has been a digital ID wallet mandated by late 2027. So targeting 80% adoption by 2030. When this happens, applications will arrive as pre-verified credentials, completely changing the originations flow. Ultimately, as Deloitte notes, fraud defense will turn into what they call invisible intelligence. So fraud checks will move completely inside the origination workflow itself, operating invisibly in the background. So proving that a genuine human presence is in front of you and also behind the screen will become the basic entry price to fund any asset deal. The window to adapt is closing, and the gap between lenders who can see the actual applicant and those who cannot is widening every single quarter. So with that, Tommy and I, we'd like to open the floor to our live Q&A. So looking at Grace here, because do we have any questions that are coming from the audience? Because I seem to have an issue with my chat window.
No questions as of now.
Okay. Maybe let me just ask Tommy again, for those who haven't maybe heard it, but how does your platform, how does your tools handle first-party fraud when the applicant is technically a real person with a real credit history?
Yeah, no, that's a great question. So we have a few different things that we do, right? As I mentioned, we are a big modeling company. So we have multiple first-party models, and we have just raw consortium attributes that we utilize to help provide some strategies and decisions. So from a modeling perspective, we have 2 that are currently deployed. We have multiple ones that are in production, and they all look to target different aspects of first-party fraud. So the first one is, what we call our identity manipulation model. And that is, you could think of that as, right, Tommy looking to change some of my information, maybe to hide bad past behavior or to avoid collections or something similar by maybe using a different phone number or fat fingering, right, an SSN or a date of birth to try to bypass, right, some bad history. We also have a dispute model that, generally we look at it as our dispute abuse model. And really that is looking to provide a predictive score. All of our models provide predictive scores ranging from 0.001 to 0.999 on the likelihood of a dispute being fraudulent. So when you think of the identity manipulation, That could be used, at an onboarding event. So could the dispute, but a lot of our customers actually utilize the dispute model when a dispute occurs. To say, okay, are we going to work this dispute? Are we going to just allow it through? What do we do? And then we have our consortium metadata that we also provide. So every call to the first party fraud product gives those 2 model scores, but also gives an output of our consortium for that resolved identity. Now, there's no PII that's returned. And I think it is important to note, right, like that we utilize the same PII you would do for your bureau call. So you don't have to go through and collect anything extra. It's what you're collecting for the bureau call would happen through here, all directly through the platform. But what we send back, right, from the first party output is information such as how many, right, phone numbers, how many emails, how many addresses do we have on file for this individual? How many accounts do we have this individual? What are the account open dates? What are the account close dates? If you recall, I had shared earlier, we see about a 68% increase in fraudulent risk, right? When someone went through and opened up 2 or more accounts in a 6-month period.
2 accounts, yeah, exactly.
So
yeah.
we actually give those account open dates. And we give those account close dates. We also give dispute dates and chargeback dates and ACH return dates for when those events happen. So you can actually look through and see, okay, Tommy actually went through and opened up, 4 bank accounts in a month. That's odd behavior, right? That's not something we would expect someone to normally go through and do. And it's not saying do an outright reject for them, but put them under some enhanced scrutiny, right? Do some due diligence. Yeah. Friction them a little bit and challenge them to go through and maybe collect extra levels of documents, right, that you might not collect normally.
Exactly. So, dear audience, I think as you can see, this is a very thorough process. Obviously, those models have been developed over quite some time, and ML has been enriching data and adding insights into this. So, yeah, for any questions, I think in the future, please refer to us directly. Here are our LinkedIn's. Here's our LinkedIn information. So if you want to connect directly to us, to Tommy and myself, anytime, we'd be happy to speak to you. And obviously, thank you again also for Grace, to AFSA, to manage this webinar. In case you have anything else to send to us, please feel free to contact us. In the meantime, thank you again, Tommy, for doing this webinar with me. Yes, likewise, great partners here. Thank you again and have a wonderful day.
Thank you, everybody.
Thank you so much, Eva and Tommy, and everyone for joining us. Just a reminder that the recording will be available on our webinar page next week, and I hope everyone has a great rest of their day.
Thank you so much, Grace.
Great. Thanks.